Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about STEELCASE INC quarterly report. STEELCASE Inc. offers a diverse range of businesses and services across various sectors. These include furniture system seating products, task chairs, collaborative seating, casual seating, storage solutions desks, fixed and height adjustable, benches and tables, complementary products, work accessories, lighting, mobile power, screens, interior architectural products, full and partial height walls, architectural pods, textiles and surface imaging products, workplace strategy consulting services, lease origination services, furniture and asset management services. The significant increase in STEELCASE Inc.'s stock price by 33.48% over the past year can be attributed to one major event, its acquisition by HNI Corporation. On August 4, 2025, the announcement of a definitive agreement for HNI to acquire STEELCASE in a cash and stock transaction valued at $2.2 billion sent shares soaring. The deal, which is expected to close in the first half of 2026 pending regulatory approvals, has driven STEELCASE's annual stock performance with an overall increase of 47.45%. This acquisition news was the primary catalyst for the company's impressive stock growth, surpassing other positive financial results reported by STEELCASE during this period. The primary drivers of revenue growth or decline can be identified through an analysis of the financial summary provided. Revenue growth is primarily driven by the international segment, which saw a significant increase of 11.3% in desking, benching, systems, and storage sales, and 12.8% in seating sales from Q2 2024 to Q2 2026. The Americas segment also experienced revenue growth, with desking, benching, systems, and storage sales increasing by 1.6% and seating sales increasing by 2.1%. Key drivers of revenue growth include large corporate customers in the Americas, which saw a 6% increase, as well as strength in the India market, where international segment sales increased by 13%. Additionally, pricing benefits helped to offset tariff and inflation costs, while favorable currency translation effects added $8.5 million to revenue. On the other hand, revenue decline is primarily driven by the international segment's 13.1% decrease from 2024 to 2025. This decline was largely due to a decrease in sales to education customers in the Americas, as well as declines in France and Germany. The Americas segment's revenue growth was not sufficient to offset this decline. Net income and profit margins decline due to increased costs. The company's net income and profit margins have experienced a decline over the past year. In Q2 2024, net income was $63.1 million, which dropped to $35 million in Q2 2025, representing a decrease of $28.1 million, or 44.6%. Similarly, in HON 2024, net income was $74 million, decreasing to $48.6 million in HON 2025. The decline in profit margins is also evident, with the gross profit margin decreasing from 34.5% in Q2 2024 to 34.3% in Q2 2025, and the operating profit margin dropping from 10.5% to 8.6%. The main reasons for this decline are increased restructuring costs, which rose significantly from $1.9 million to $3.6 million, and higher operating expenses, increasing from $205.1 million to $247.1 million. Additionally, investment income decreased slightly, contributing to the overall decline in net income and profit margins. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. Despite the lack of detailed information on specific revenue or expense items, the stark figure of -$82.2 million in negative operating cash flow is a clear indication that the company is struggling to cover its operational costs. This trend suggests that the company may be facing financial difficulties and requires immediate attention to rectify this situation. The company's financial health has shown a mixed trend over the past period. While its total liabilities have decreased from $1,378.7 million to $1,335.6 million, indicating a slight reduction in debt level, the total debt remains relatively stable at around $447 million. However, interest expenses have seen a significant decrease of $6.3 million for the 3 months ended August 29, 2025, compared to the previous period. This suggests that despite some fluctuations, the company's financial situation has improved with reduced interest burden. The Americas segment performance overview. In the second quarter of 2025, the Americas segment experienced mixed results. On one hand, revenue growth was a notable achievement, increasing by 3% to $707.1 million compared to the same period in 2024. However, this growth came at the cost of operating income, which decreased by 33% to $67.7 million. This decline suggests that while the segment is generating more revenue, it is struggling to maintain profitability. Management is signaling a positive outlook for the company, despite interim results not being indicative of full-year performance. They are focused on managing investments to minimize risk and volatility, while prioritizing cost reduction and revenue growth through restructuring actions. The company expects its adjusted operating loss to decrease significantly by 2026, indicating an improvement in its financial position. Overall, management is emphasizing the importance of strategic initiatives and growth areas, alongside optimizing operating efficiencies. Acquisitions and divestitures overview. The company has made significant moves in its business operations through acquisitions and divestitures. Notably, a proposed acquisition of STEELCASE by HNI is underway. On the other hand, the company has been streamlining its operations through divestitures. In terms of divestitures, the company plans to close 2 regional distribution centers, one in EMEA, Cone 2025, and another in Atlanta, Georgia, Cone 2024. Additionally, the company has sold various parcels of land, resulting in significant gains. In Q2 2025, a gain of $27.9 million was recorded, while in Q2 2026, a gain of $1.2 million was reported. These divestitures aim to optimize the company's resources and reduce operational costs. Overall, these strategic moves demonstrate the company's commitment to adapting its business model to remain competitive in the market. The company has a history of paying dividends to its shareholders. According to the financial summary, the company has indeed distributed dividends to its investors. This indicates that the company is financially stable and has generated sufficient profits to reward its shareholders through dividend payments. Concerns surrounding inventory buildup and supply chain disruption. The company's financial summary reveals a significant concern regarding inventory buildup. A substantial increase in total inventories from $274.9 million to $319 million, 16% growth, is evident on page 15 of the report. Furthermore, page 29 indicates that cash used to fund inventory purchases has decreased, suggesting potential cash flow issues stemming from this buildup. This trend raises concerns about supply chain disruption and the company's ability to manage its inventory effectively. The accumulation of excess stock may lead to wasted resources, reduced liquidity, and increased costs associated with storage and maintenance. As a result, it is essential for the company to reassess its inventory management strategies to mitigate these risks and ensure a more efficient supply chain. That concludes the financial summary for STEELCASE INC. Feel free to comment below, and I will be happy to answer them when possible.